In the meantime, the broader market may be retreating, but the Mag 7A team, Apple and Amazon, both hitting intraday records. They are kind of the two safe havens now, or are they getting too hot to handle? And after multiple market records, what else might be entering the danger zone? Let's get right to the floor show. Joining me now with $590 billion in assets under management, Allspring Global Investment Senior Portfolio Manager Bryant Vancronkhite and Slatestone superstar trader Kenny Polcari. Bryant, I'm going to begin with you. You're striking a very reasonable but slightly sort of disconcerting tone about the markets at the moment. Tell me what you see.
I'm very worried about complacency with most investors. The S&P 500 has been the gift that keeps on giving. The Mag 7 has been a big part of that right now. But looking at valuations, we're in a pretty precarious spot right now. Market cap to GDP is very high, usually leads to relatively modest returns from here. But if you get into nuance, into the weeds, the Mag 7 is 30+% of the S&P 500, and the earnings growth rate for the Mag 7 is coming down. And it's colliding with what I'm calling the modest 493. And as it does, do we still want to pay these high valuations for these Mag 7 stocks that are at 7 times price to sales? I'm getting worried about complacency if you hold that.
Aside from the valuations, you see several, let's call them yellow warning flags. Not necessarily red, but certainly things that you say investors need to take into account. And among them, you say, again, stretched overall valuations, passive exposure in the Magnificent Seven, uncertain fiscal spending under the future President Trump could make the Fed's job harder. What would that have to do with how the market moves? Because people have put up warning flags for a couple of years now, and if they sold out of the market, they've lost.
Yeah, that's exactly right. But at an interesting level, the Fed's job is to predict the future. They're going to use data, but they also need to predict what's going to happen because there's a long lead time, a long lag time to what they do. And it needs to work hand in hand with fiscal policy. And it's just very possible that the current or the incoming regime is going to have more volatility to it, more uncertainty as to what's going to happen, which makes it hard to predict whether we're going to see fiscal expansionary policies, different tax policies, tariffs, et cetera. And so if they can't have visibility on fiscal and inflationary pressures, it's hard to make decisions. So I think the Fed's job got a little harder. I wouldn't say they're going to make mistakes, but we need to consider the chance of an error. And if there is an error at these valuation levels, the downside could be significant.
Well, could the error, Kenny, be a week from Wednesday, which is when the Federal Reserve makes its announcement about its decision on interest rates for the final meeting of the year? You said last week, right here on the show, I don't think the Fed should cut. I mean, we've gotten some really strong data. We're getting more this week. Consumer price index. We are also getting the producer price index. Those are two key inflation gauges, with which, if you look at the expectations, they look really kind of sticky. 3.3% for core PCE. So what if the Fed pauses? Which would be the mistake, a pause or a cut?
I think a cut is going to be the mistake. I think they should pause. I think they've been very aggressive in September, October. I think the data, to your point, is suggesting that not only is the labor market robust, but that the economy and inflation are starting to kind of tick the other way, right? They're going to start to trend upwards and not downwards. So I think the Fed should do nothing, but the market has taken control of this conversation, and 89% expect this rate cut. So if they don't get it, they're going to stamp their feet and scream and yell and, start to sell stocks and create a mess all over the place, which, by the way, I wouldn't be so opposed to. I agree with Bryant. I think Bryant must be reading my morning note, because everything he said is what I think, is that I think we're stretched. I think you have to worry about complacency. The VIX is at all-time lows. And while I think the Fed is going to cut because I think they're backed into a corner, I don't think they should.
Okay. Well, Bryant, one of the sectors that you point out is looking somewhat frothy are the smaller and regional banks. Mm-hmm. They have had an unbelievable run-up this year. And that's certainly encouraged because we like small banks to do well. They're community banks. They're the ones who lend to the small businesses most easily. But why do you say avoid these right now? Because they have run up so much?
Well, I think people are just pulling up the 2016 playbook. Let's assume Trump comes in. All of a sudden, you have massive tax cuts. The economy surges higher. And that's great for the high beta, small regional banks. But the reality is the fundamentals aren't inflecting in a material way. We're not going to see significant tax cuts. We're probably going to see some potentially. But valuations have ripped. And they're ripping on deregulation, which probably happens. But I think what people are betting on is consolidation. And whether you're the winner or loser with your bank stock pick from here is whether you buy the company or buy the stock of the one that gets taken out. I don't like that setup. Banks are still challenged businesses, and the large cap banks are the winners long term. I still prefer large cap banks over small cap banks, and if you want beta, go buy industrials and materials, which look much more attractive to me right now.
Okay, why? What PE ratio should you be looking for those kinds of sector names?
In the materials and industry
Correct.
space, it really depends on the business, right? What I want to own right now are companies that have strong pricing power and have really financially free balance sheets. The only way you control your destiny today is not by betting on regulatory, betting on GDP. Bet on the balance sheet being used to drive a change, an acquisition, organic investments, buying back stock. So look for companies that have reasonable valuations. Don't buy cheap, but they have control of their destiny by using their balance sheets.
And some of these names are Vulcan Materials, Graphic Packaging, and Charles River.
That's exactly right. Yeah.
What are those names offering to investors right now that you say is an easy choice?
All three have a little bit different perspective right now. Vulcan is an aggregate player that's going to give you upside to the economy as it grows with tremendously good pricing power and discipline on operations. Graphic Packaging is going through a really important change right now. They're moving the quality of their cash flow up the quality curve, giving them a lot more financial freedom. They're just wrapping up a big CapEx spend. I think the market's misunderstanding the amount of cash flow they're going to produce in the near future. And Charles River is in the healthcare space. Everyone hates healthcare right now. Money is flooding out of that. But Charles River is a secular winner in the clinical research space. They're investing through this trough, which ultimately makes them a big winner cycle over cycle.
And who knows, some of these may sell off if there is that moment, Kenny, that we're talking about. And I'm with you. You know, people shouldn't fear a correction. That's an opportunity, is it not?
Right. It is an opportunity, especially since I think valuations are stretched so much that you could see the market, you know, if it doesn't like what it hears, get one bad headline, or the Fed doesn't cut rates next week and suddenly everybody panics, you know, that the trader types will run for the door. And if the market backs off, 5 or 8%, I actually think that's healthy. I'd like to see that shake the branch a little bit after this run-up that we've had since the election and let it settle down a little bit. Look, I'm bullish on the market. I'm bullish going into next year. But to Brian's point, you have to be careful because there are certain sectors that I'm just absolutely not chasing. I own them, but I'm not chasing it up here and buying any more, for sure.
Okay. Let me just say thank you to both of you.